Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Fabian Crain, and today I'm speaking with Michael Egorov.
I thought, what if we have voting power not equal to number of tokens? But what if we lock the tokens and the voting power will be proportional to number of tokens and time left before unlock? So if you lock tokens for like the maximum of 4 years, you have maximum voting power. But if you lock tokens for 1 year, your voting power is 4 times less.
What do you think would be the kind of yield that people would be able to earn?
Like 20%. It can go down if liquidity in YieldBases starts suppressing Bitcoin volatility globally. And question is, where is this limit? Something around 50 billion TVL, I guess. Right, so
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Fabian Crain, and today I'm speaking with Michael Egorov, who is the co-founder and CEO of Curve Finance, which was one of the most influential, original, most successful DeFi protocols. And more recently, actually very, very recently, just a few weeks ago, has launched a new protocol called YieldBases, which is also very interesting and is tackling one of the most tricky problems about AMMs, or automated market maker impermanent loss. So I'm really excited to talk with Michael about this today. So just before we get into that, I would like to share a few words from our sponsors this week.
This episode is brought to you by Gnosis, building the open internet one block at a time. Gnosis was founded in 2015, and it's grown from one of Ethereum's earliest projects into a powerful ecosystem for open user-owned finance. Gnosis is also the team behind products that have become core to my business and that of so many others, like Safe and CowSwap. At the center is Gnosis Chain. It's a low-fee layer 1 with zero downtime in 7 years and secured by over 300,000 validators. It's the foundation for real-world financial applications like Gnosis Pay and Circles. All of this is governed by Gnosis DAO, a community-run organization where anyone with a GNO token can vote on updates, fund new projects, and even run a validator from home. So if you're building in Web3, or you're just curious about what financial freedom can look like, start exploring at gnosis.io.
Thanks so much for coming on today, Michael. It's really great to have you back on. I saw we had you on, I think, 4 years ago, over 4.5 years ago already, to talk about Curve. So it's been quite a while.
That's right. Yeah, I guess it's the time flies. So you said I'm a co-founder of Curve, but there is no other founder.
That's right. Yeah, the only founder, right?
So I guess co-founded with my laptop.
Yeah, with your laptop, yeah. I should also mention a disclaimer that through my company, Course One, we are an investor in YieldBases as well.
Right.
So let's maybe we can. I think mainly we want to speak about YieldBases. But for those who are not familiar with Curve, maybe just a few. Can you give like a very quick background on what Curve is and what are your biggest learnings from Curve?
Oh, absolutely. So Curve is, I would say, probably best known as the venue for exchanging and providing stablecoin liquidity to swap between stablecoins and between, I would say, between LSTs as well. I started it back in 2020 because, well, with one of the reasons being because I was a big user of MakerDAO, borrowing DAI against ETH because I didn't want to sell precious ethers, and but I needed some funds, so I borrowed against ETH. And you could borrow, sell DAI on, I don't know, somewhere, and withdraw USDC as USD in Coinbase or something. But I found that actually exchange between stablecoins was very, very suboptimal everywhere. On centralized exchanges, on DEXs like And at the same time, I was thinking about making liquidity for what we now call LSTs, liquid staking derivatives. And I thought, well, actually the same algorithm is applicable to stablecoins. So I launched Curve with with the ability to make stablecoin liquidity, and already at 1 million TVL, it outperformed everything in existence in this area. And yeah, it just grew since then. And of course, it since then expanded to well, Bitcoin wrappers, staked ethers, even volatile pairs, and actually what powers YieldBases is some modifications of crypto pools for making liquidity between in volatile pairs. So, and after that, Curve actually created its own stablecoin, crvUSD, as well as lending protocol with some very interesting mechanisms like unliquidations and also, of course, Curve is governed by crvDAO, for which I invented veTokenomics. And I iterated further on that in YieldBases because I think it was, was nice to somewhat update what token economic designs do.
Yeah, absolutely. I think there's a lot of stuff there to go into. Just right, to zoom out a little bit, right? So I guess the thing in something like a Uniswap or right, a traditional AMM, right, is you'd basically, let's say you have like a USDC, USDT market, and then, people provide liquidity on both sides. And then as you put in, let's say, USDC, then the price of USDC goes up, right? So it becomes more and more like a little bit. No, down. Yeah. Like you putting it down, right? You putting in USDC, taking on USDT, and then price keeps going down, and then very quickly because the sort of protocol thinks that means it's losing value, right? Because it doesn't have, it's sort of an internal price predictor, right, based on the trading volume of the exchange. So then especially for stable pairs, right, it doesn't make any sense, right? Because they're basically worth the same.
There is pricing. So price is not set to 1 in Curve, actually. It never was. But Curve has what we now call concentrated liquidity. The very first concentrated liquidity was Curve. But it's not that concentrated liquidity where you handcraft your liquidity distribution. It's a concentrated liquidity where it's distributed according to some special bonding curve, which concentrates liquidity around the price 1.0. So, because that maybe having liquidity at price 0.5 is kind of useless in stablecoin world, right? So you probably want everything to be around 1.0. And apparently the bonding curve, which is in Curve, that's hence the name, is actually very efficient. So I don't think anything in existence provides significantly bigger efficiency than that.
Yeah.
For stablecoins, at least.
Yeah. Maybe let's talk about the veTokenomics, because I think veTokenomics is something, that you've seen come up in other places. I think a lot of people ended up copying it. But can you explain what was the problem you're trying to solve, and how do veTokenomics work?
So the original idea was aligning the governance with the long-term success of the protocol. And the problem is this. Imagine that someone controls the protocol with tokens or shares or whatever. So the more tokens or shares they have, the more voting power they have. What if they, for example, let me just bring you one example, which I think what have happened. Maybe it's not that, but maybe it is. So it's still a good example. You remember how back in the days there were several crashes with Boeing Max aircrafts, right? And well, the real reason for these crashes was essentially low quality of low quality of production because the company was trying to save money on everything. But why did they try to save money on everything? Well, it appears that they switched a bunch of revenues to share buybacks and didn't spend much money on improving quality. So, shares went up, but they didn't have much money for the company to operate. So they had to fire some good engineers, and of course, quality of aircrafts deteriorated, and it led to a few catastrophes. And guess what? Shares started dropping, but apparently a bunch of shareholders already sold their shares by that time. And who knows, maybe they shorted. But then US government salvaged the company and they bought the dip. And shareholders benefited, but it was not great for the company at all. Maybe it's not what happened, but that's how it looked. It seemed to me. And I thought, well, what's the fundamental reason for this to happen? Fundamental reason is that shareholders are not aligned with the long-term success of the company. So what if we do this? What if we align token holders with the long-term success of the project? How do we do it?
Okay, so and how did you use tokenomics then to align these incentives in the protocol?
Right. So I thought, what if we have voting power not equal to number of tokens, but what if we lock the tokens and the voting power will be proportional to number of tokens and time left before unlock. So if you lock tokens for like the maximum of 4 years, you have maximum voting power. But if you lock tokens for 1 year, your voting power is 4 times less. Or if you lock tokens for, I don't know, for 1 week, then your voting power is, I think, 0.5% of someone's voting power if they locked for 4 years. So that's essentially the idea. So someone who has longer term alignment, hopefully maximum, has the biggest say in the future of the protocol. And that indeed worked. Indeed, this produced some long-term alignment, not necessarily of physical people, but also long-term alignment of protocols built on top of Curve, like Convex or StakeDAO or Yearn. And they are all passionate about moving Curve forward. So this, in a sense, worked. But that was not the only thing. As you can imagine.
Right,
Yep.
because I guess the way I'd imagine people would sort of like sort of work around it is if you can just then like you put that into some pool and that stakes for the maximum duration, and then they issue like a liquid token, right? That you can like
True.
immediately.
That is of course true. But then you of course give your voting power to that protocol, right? So that protocol decides how to use this voting power. That's one thing. Another thing, if people who do that decide to exit, then this derivative wrapper of the locked token will depeg, and it will go down from parity, and people will stop selling it because there is not enough liquidity to do it. So you turn essentially you turn this waiting for unlock into the market discount.
Yeah. And then what was the impact or like, what do you think were some of the positive effect of creating this tokenomic?
Right. One positive effect which I didn't necessarily think of. It appears that locking the tokens removes them from circulation actually way faster than buyback and burn would do, around 3 times faster. So if Curve basically collected revenues, which the protocol has, and bought CRV tokens from the market and burned, it would have removed 3 times less tokens from circulation than locking removed. So it appears that veTokenomics actually practically is more efficient for decreasing the circulating supply, which is what, well, I had no idea that this will be the case when I started this. So it's a very interesting economic consequence.
So, I mean, I don't know. And if you are now, as you kind of started working on a new protocol, are there particular things you feel like you've learned or your biggest lessons from building Curve where you felt like this is something I want to do differently?
Yes, absolutely. So there were some details about how veTokenomics works, which I wanted to change. Well, for once, veTokenomics actually wanted to resist this wrapping, and this wrapping happened anyway, but it created an obstacle of locking for multi-sigs, essentially. So I removed this obstacle in VEYB. So even multi-sigs can lock VEYB, that's fine. Another thing, in veTokenomics, one of the functions of VE tokens is boosting your token emissions. So let's say if you put money in the pool, stake it to earn CRV tokens, then you can earn more CRV tokens if you have veCRV, which seems to be a nice function of VE tokens. That's right. But it encourages creation of natural monopolies in who hold veCRV. And that is not necessarily bad because they did a good function, but nevertheless, it's a little bit less decentralization. Well, they are decentralized within themselves, but it still felt like something wrong about that. So and also boosting token production by having VE tokens is a little bit technically difficult. So I decided to remove that function from VEYB. So it's VEYB is not doing that thing. Well, another thing, which is not necessarily directly veTokenomics, which I wanted to try, is splitting revenues between staked and unstaked. So in Curve, there is no reason to not stake your liquidity. So if you provide liquidity on Curve, you earn, of course, fees of the pool. And if you stake, you also earn CRV tokens. And there is no reason to not earn CRV tokens because, if you don't do that, then you just earn less, right? So why earn less? And people who earn CRV tokens, they sometimes they don't need CRV tokens, so they kind of sell them. And so it's and it's a complication for integrations. So I thought, why not do it differently? Why not make it so that there are 2 kinds of people? One, people want to earn natural yield, right? So natural yield protocol is earning, so they have auto compounding value, which is growing in their wallet. And those who don't want natural yield, those who just want to hold the stable value of what they put in and earn protocol tokens, YB tokens. And that's what I did in YieldBases. So you essentially split between 2 kinds of liquidity providers. And I think that is good for integrations, because for integrations it's actually much easier to integrate something which doesn't earn tokens, something which just automatically compounds value, and it allows to split between two kinds of people who want to collect valuable governance tokens and not sell it, hopefully, and who want to just earn real yield, and they would have sold the governance tokens, but they just can earn real yield in the first place instead. So that's the idea. And I
So
don't
that's
think,
kind of similar to what Pendle did, no?
I don't know, actually. I think the encouragement for me was not Pendle. It was
Yeah.
how you split yield in convex. You can stake CVX CRV and can choose whether you earn CRV tokens or you earn stablecoins.
Yeah, no, absolutely. I think that makes perfect sense, right? And it seems like a sort of win-win from both sides, right? Because on the one hand, somebody wants to use YieldBases, they want to earn yield, then they mainly just want a higher yield, right? And
Right.
if they can get higher yield, that's fantastic, right? Then other people really want to bet on the token, and then if you can sort of segregate that, I think it is very elegant.
Right. But this design leads to even more consequences which you don't think of at the start. I think you imagine two limit cases. One is when everyone wants to earn governance tokens, right? Well, and no one wants to earn real yield. Pretty easy to imagine. What happens? Then, of course, token inflation is probably at its maximum, but nobody wants real yield. If nobody wants real yield, where does real yield go? And you probably can guess it. It would go to admin fees in this case. So admin fees would be very big if everyone wants to earn governance tokens. Or imagine the opposite. Imagine that everyone is, I don't know, a Bitcoin maxi who don't really want to deal with those shit coins. They want only Bitcoin. What happens? Well, they all want to earn real fees, real yield, so they all don't stake. They have value of Bitcoin growing, that's fine, but nobody wants to earn your governance tokens. Nobody staked. So is there any reason to have token inflation if that happened? Well, apparently not. So inflation of YB token is dynamic and depends on how many people staked. And if nobody stakes, then inflation goes to zero. So that is all dynamic and all driven by free market.
Cool. So let's we haven't yet talked about what YieldBases is. So maybe explain what is the vision, or how would you describe YieldBases?
Right. So I would describe it as essentially, how to say, a vault, right? Or a set of vaults which are built on top of curve AMMs, which eliminate impermanent loss. So you essentially provide liquidity, and it is for the user, it's looking like essentially a yield-bearing Bitcoin, if it's for Bitcoin, of course, or for wrapped Bitcoins.
Right. Because impermanent loss is a weird thing, right? That I think people who have been liquidity providers in DeFi, often have sort of, painfully experienced, and other people, they have no idea what it is. But basically, right, it's in an AMM, right? So let's say you have a pair in an AMM, something like ETH, Bitcoin, and then if you let's say you put in $100 worth of ETH and you put in $100 worth of Bitcoin, now let's say the Bitcoin went up by 50%. If I just add $100 worth of ETH and ETH stayed the same, then normally I would have $250. But if I have both of those in the AMM, actually, sort of as the Bitcoin goes up, I'm selling some Bitcoin, I'm buying more ETH, and so I end up with less than $250. I end up with, I don't know, 240, 230, so some number like that. I don't know exactly.
Actually, this is easy to explain quantitatively with Uniswap 2 AMM. although it works the same with CryptoSwap AMM, right? So imagine you have the simplest AMM you can imagine, same as Uniswap 1 actually. So you put Bitcoin, 50K worth of Bitcoin and 50K worth of US dollar in this AMM, right? So if Bitcoin goes up, it sells a little bit of Bitcoin. If Bitcoin goes down, it buys a little bit of Bitcoin, or well, to the traders. So how does the price of your liquidity behave? Apparently, it is proportional to square root of a Bitcoin price plus the fees it earns on the way. So imagine that Bitcoin went up by factor of 4, right? Then your value in your AMM goes up by square root of 4 by factor of 2. So your 100K turns into 200K. Well, sounds good. But what happened if you did not put funds in the AMM? Well, 50K worth of Bitcoin goes up by a factor of 4, turns into 200K, but you have also these 50K of USD, so you'd have had 250K, and in AMM you have 200K, which is less. So sounds like you kind of missed out when you were in the AMM. And weirdly, if Bitcoin goes down, it's kind of the same thing. In AMM, you have less than if you have your funds sitting on a shelf. Of course, it's not exactly like that because AMMs also earn fees and you get a little bit more in the AMM, but fees usually don't cover this gap because Bitcoin tends to go up faster than AMM earns fees, somewhat. So this was a problem for people all the time.
Yeah, absolutely. And I've definitely experienced that in the past, right? Where I've been in like liquidity providers and AMMs with like liquid.
But I have anecdotal evidence from people who LP'd between CRV and ETH, and they've been very happy. They LP'd that in Uniswap 2 for several years, and they've been up both in terms of CRV and in terms of ETH. But it is one of the rare examples where fee were actually bigger than the IL.
Yeah, exactly. But so the challenge, like, let's say if we take the Bitcoin example and you guys focus on Bitcoin, at least initially, then, people tend to want to hold on to their Bitcoin. So they're kind of reluctant to put it into any kind of AMM because they're like, well, there's a good chance that I'll end up with less Bitcoin in the end because of impermanent loss. And like, I don't want that.
Right.
So how does YieldBases get rid of impermanent loss?
Yeah. Well, as I mentioned, the price of your liquidity, but like base price, is proportional to square root of Bitcoin price. So it feels like it's actually not a real loss. It's kind of almost a mathematical loss. So you really want to get rid of that square root somehow. And apparently it is possible. And you just need to construct some position which inverts this square root function. And, well, what position could that be? Apparently this position is leverage, but it's not a typical leverage, it's compounding leverage. So leverage where you keep loan to value ratio constant all the time. To have leverage of factor of 2, you need 50% LTV, and if you maintain that, then your leverage makes your position being square of the price of your collateral. And if your collateral is your AMM position, then you have square of the square root, so it cancels out, and that will be proportional to Bitcoin price, plus the fees it makes, minus any sort of expenses or losses you have on the way. But this would be not impermanent loss. So it's so you can get rid of impermanent loss this way, but then you have to check, are you actually net positive or no, right? And it appears that you are actually net positive if you use the right AMM under the hood.
Right. So basically, right. So we said before, I'm trying to. So let's say you have like the 50K USD, and you have the 50K Bitcoin. That's kind of like the traditional way, right? But now we want to somehow get rid of the impermanent loss. So instead of a person putting in USD and Bitcoin into, let's say, the Curve AMM directly, they put just Bitcoin
Yep.
into the YieldBases.
That's right.
And so let's say they put in 50K worth of Bitcoin.
And actually, I think better to explain it like 100K worth of Bitcoin.
Okay, 100K worth of Bitcoin.
And the protocol borrows 100K worth of crvUSD, pairs with that Bitcoin, and uses this 200K position to collateralize your 100K loan. So the net value of this position is 100K.
Yeah, so exactly. So you putting in 100K worth of Bitcoin, the protocol borrows 100K of stables, and then it has this LP token, and the LP token basically represents the 100K worth of BTC and 100K worth of stable. That's the collateral
And
for the
that, of course,
100K
yeah.
debt. Yeah.
And this debt kind of cancels out on average the crvUSD part. The tricky part is that this AMM is having concentrated liquidity. So it's not XYK. It's XYK only on average, but in different moments of time, it can deviate from ideal balance. So it can be not 50-50, but 45-55 or I don't know, 60-40 or something. And so it fluctuates like that. And the loan is actually, the loan is 50%. And actually that, well, on average, AMM is also doing 50%, but it's fluctuating around this ideal value. And that is what is making it work, because that's like inevitable property of concentrated liquidity that you have it going out of balance a little bit.
Yeah. So I'm curious, under which scenarios, and what's interesting, right, is you guys launched YieldBases just before we had this, massive liquidation event. I guess it was a week ago, was it? Or 2 weeks
It
ago?
was October 10.
Yeah, so 2 weeks ago, right? Which caused lots of chaos in some, at least in some centralized exchanges, some protocol, DeFi protocols. How did YieldBases handle the volatility and liquidations that happened there?
Right. So I actually studied this quite a bit. So first thing I checked, there are actually two AMMs in YieldBases. One is Curve AMM and another is a releverage AMM, which keeps the leverage constant. And there is a spread between these two AMMs. When things are very calm, spread is actually huge. It's like, I don't know, 2% or something. But when things are volatile, spread can go down to almost zero. But the weird thing, if arbitrage is not happening, then spread can go negative because it's not, it's not worth the gas for arbitrage traders to trade. And that is what happened on October 10. And I thought, oh my God, this should be inherently lossy when the spreads are negative, because AMM gives out value. And well, that's happening because gas was very high and it was not worth the trade for arbitrage traders. And at the time, TVL was still a little bit small. So bigger TVL is better. For bigger TVL, gas doesn't matter. But for smaller TVL, it does matter. So, and the TVL was smaller. So I thought, well, maybe TVL is too small for these gas prices. And, well, I tweeted about that. But then I actually studied it more. Like, did the system actually fundamentally make money or lose money at that time? because it could be either because if arbitrage is not happening and it relies on arbitrage. It appears that actually it net earned money. So it was that crash was actually good. Probably it would have earned more money if arbitrage was happening better. But yeah, it was interesting. And what's even better, after this crash, someone like turned volatility on, like Bitcoin woke up, started being volatile. And volatility is what earns yield in YieldBases. So it was actually very, very good. Well, I mean, not to say that I wouldn't call the crash very, very good, but volatility turning on was a good one. And by the way, this crash was, allegedly called by USDE depegging on Binance, but on crvUSD did not depeg at all. It was super stable. It's just, I don't know, was due to all exchanges, all futures or whatever, looking at price on Binance, but it was the wrong price. Thank you. Your microphone is off.
Yeah, that's great to hear that YieldBases performed so well in that context. I mean, let's talk a little bit about the metrics around the launch. Like, what have you learned about the behavior of the system? And I realize it's still early phase, right?
It's still early phase indeed. It's capped, and that's good. Our cap was going up gradually, right? So first, the goal was to actually verify that everything is working as expected, although there were multiple audits and everything. You can never know, right? Well, it looked fine. Then the caps were raised, and right now the caps are at 150 million total, and that is a healthy number to make sure that gas is not an issue and system performs as it should. I found a few things on the way while this was operating, so I would be rolling out a new version of the pools with liquidity migration. I think the biggest thing is how value is split between staked and unstaked. It really depends on how you measure profit. And how you measure profit, this metric is inherently volatile. And this volatility of this profit metric, it goes into the value of staked tokens, right? So you want this volatility to be as small as possible. So I started thinking about it after talking to multiple people, and I realized that I actually can reduce this value volatility by about factor of 10. And I implemented that in one day. Auditors are still looking at it. I think we are about to put this new version out and migrate liquidity to the new version of the pools to make this value volatility smaller, because otherwise you have growth happening. It's actually measurable what the growth is, but the real value, it fluctuates around this growth. And it's like people saying, oh my God, I'm down 1%. Why? And then, oh my God, I'm up 2% in one day. What's going on? And but it's really noise around the growth, and growth is not that fast. You cannot grow 2% in one day, and you cannot drop the fundamental value by 2% in one day. You just have jumping around happening around this growth. So I just figured how to reduce this growth, this volatility somewhat, and that's worth a new version before scaling up more, because the eventual scale, which can be, is much bigger than it is now. So we got to figure out everything before we scale.
So regarding scaling, right now, I mean, YieldBases, right, is this vault where I'm as a Bitcoin user, I can put my Bitcoin into the vault, and then that provides liquidity in Curve, right, for a crvUSD pool with these Bitcoin versions. Of course, you could imagine scaling in a few directions, right? Like one could be maybe providing liquidity also on, I don't know, Uniswap or maybe other types of AMMs, or
No, you cannot do that, I guess. Yeah, I
cannot do
cannot.
that.
I cannot imagine how you can do it on top of Uniswap. Really,
Okay,
it's
okay.
like it just wouldn't work. It
Wouldn't work.
would be
Yeah.
maybe you can, but no, not really, I guess.
Okay.
You're,
So you think YieldBases is really like will just serve on Curve, providing liquidity on Curve. Okay.
yeah, just
And
that.
and then initially, right, we have to focus on Bitcoin, and of course, Bitcoin is the largest asset by far. It's also something where it's hard to earn yield in other ways.
Right, right. Well, I guess the idea is that I want to get most of Bitcoin background liquidity from away from centralized exchanges to on-chain. Just essentially like it happened for stablecoins.
Yeah, yeah. And what is your expectation? I think you did some like modeling with historical amounts, and I guess we have a little bit of real data now. But what do you think would be the kind of yield that people would be able to earn?
Well, it's a good question because after October 10, the natural APR appeared to be super high, like 20%. And I don't know if it sustains, but so far it does for some reason. So 20% APR in for just from the fees right now. And I cannot really promise that it stands like that, but that's what observations show so far.
But 20% APR, I mean, I presume if you were to remove the caps, then people are going to be like 20% is incredible. Let me put my Bitcoins in there, and
Right.
then you'd end up
Well,
with
the
a ton
question
of
is
Bitcoin.
it's not the token APR, so it has nothing to do with tokens. It's the APR from Bitcoin volatility. So if it can go down if liquidity in YieldBases starts suppressing Bitcoin volatility globally. And question is, where is this limit? How high is the liquidity to suppress Bitcoin price fluctuations?
So the 20% is not something that primarily comes from the trading fees, but it's something.
It is, well, I mean, it is from trading fees, but trading fees come from volatility.
Right, because people basically say, oh, you have a decoupling between the curve pool and like the
So it's arbitrage,
yeah,
and it matches the numbers pretty much match the arbitrage model. So my simulations simulate arbitrage, and it's almost arbitrage. It's a little bit bit more than arbitrage because you have natural swaps like by cow swap or Kyber or even curve UI. But I think around 80% of the trades at least is arbitrage. And I counted on 100% arbitrage when I was simulating. If you have natural volume being bigger than zero, right? Then of course you have more revenues than just arbitrage. But even just arbitrage is giving you good numbers.
So then you think YieldBases can like how big can it accommodate? I mean, it can be billions? Can it be like $10 billion worth of Bitcoin or like?
Good question. I tried to estimate when does it start affecting Bitcoin price and like when will it affect its own yields by its own liquidity by the means of making Bitcoin more stable. I think it's something around 50 billion TVL, I guess. Right. So, well, it's not unimaginable. It's comparable to Avi TVL, right?
Right.
So it's not like something we've never seen. It's just, it's just making really good fees, but TVL is not something unimaginable.
Yeah. Yeah, that would be enormous.
Yeah, that's the goal. Well, of course, we have not only Bitcoin, we have also ETH, and we can make liquidity for ETH, and who knows, maybe something else. But we shouldn't really get too crazy because I'm pretty sure it cannot work with very volatile coins. Like, I don't know, like DeFi tokens or meme coins, I cannot think it will work because they tend to sometimes change the price too rapidly by factor of 2 or something in one block and stay down or I don't know, stay up. You cannot really work with that.
Right, because you need to rebalance like quickly enough.
Yeah, you have you have to have the price being more or less smooth, right? Even with ETH price, when I was modeling, I've noticed that, for example, if you look at ETH prices during FTX collapse, ETH price collapsed fairly rapidly, like instantly to, I don't know from what to what, but it does cause some losses in the algorithm, like -5% on the spot. And that's ETH. So imagine what happens if you use some meme coins. So please don't do YieldBases on meme coins.
Yeah. And then I guess even on October 10th, right, we saw like, I mean, I don't know what it looked like for Ethereum there, but it seemed to drop like super fast.
Yeah, I will include that in simulations when I'm simulating parameters for Ethereum. So before rolling Ethereum out, all the parameters are really carefully simulated. Like if you have the range of parameters different from, like seriously different from what it is now, then instead of having profits, you will have losses, right? So
And then in the Ethereum example, of course, there is also the ability to stake ETH. Is it, would you be able to somehow get the staking yield as well or not?
I think so, yeah. Why not?
How would you do that?
Well, I think the simplest way would be to just use, I don't know, staked ETH instead of ETH, right? Then, by the way, then what then happens? Yeah, you essentially would earn staking yield on top of your YieldBasis yield, which is, I don't know, not bad, I guess.
Yeah.
Well, not much, but honest work, I guess.
Yeah. Then what do you think about expanding to other chains? You know, like I don't know, like a Solana or other EVM chains.
Yeah, absolutely. It is possible. And I think, well, at least that's how I planned it. It's possible to do it differently, but I planned it so that each new chain should get its own governance token, right? Of course, all the investors will have their distribution honored in all the new tokens, but otherwise the token split can be a little bit different so that you align with these chains, I don't know, marketing or whatever the rules are on that chain to make sure it's well aligned with the local ecosystem and whatever. And also you don't really have to deal with breaches. So you can actually have native, I don't know, native YieldBases, which is dedicated to this chain, and you are not relying on some, I don't know, some DBNs or whatever. So it's like really living there, and you don't introduce more risks in the system essentially.
And so the way you enforce this is because I guess somebody could just sort of copy it without permission or there's some kind of license on
Well,
the
there is, of course, license, but apart from that, it's well, it requires some very particular knowledge to figure out the right parameters, and you need to do that from time to time. And I don't really think that people yet figured out how to do it properly. So I would be fairly surprised if someone successfully forks it, because it's not really well, dumb forking wouldn't really work here.
Yeah, right.
But at the same time, it is totally possible to make some deals with talented people to maintain something running and whatever. Like that's a possibility. But
Yeah.
of course, the team can also do that, depending on capacity. So yeah.
So I'm also curious about the the relationship here between YieldBases and Curve going forward. I mean, of course, in some ways it seems very symbiotic, right? So YieldBases kind of becomes a big liquidity provider for Curve. Curve presumably has more liquidity, more liquid market, maybe earns more fees. Are there ways in which there are like conflicts of interest there too, or do you see challenges in that kind of relationship?
I think challenges are usually they usually come with public not entirely realizing how big of the return would YieldBases do for Curve outside outside the token allocation part. So there is a token allocation to Curve, but the best use for it is to incentivize liquidity in crvUSD pools, which is what will be happening very shortly. For YieldBasis, it's absolutely required that liquidity for crvUSD will be big. And that's essentially why YieldBasis since YieldBasis chose crvUSD, YieldBasis makes this allocation of YB tokens to Curve. So they will be used to buy votes for crvUSD stablecoin pools, like crvUSD USDC, crvUSD USDT, and so on. And that will create, apart from big liquidity for crvUSD, it will create supply sinks for crvUSD, which means that eventually it will lead to more loans in crvUSD and more borrow fees. But also all the trading which is happening in YB pools will create volume in crvUSD stablecoin pools. And these fees generated by crvUSD pools will go to crvDAO essentially. Apart from that, there is peg keeper mechanism in crvUSD. So if crvUSD slightly depegs up or down, then peg keeper steps in and essentially buys or sells crvUSD, and it earns money for the DAO on that as well, like essentially money on passively trading the depegs. They are micro depegs, so you cannot even notice them, but they do happen and they do turn into returns for crvDAO. So that's another stream of revenue, and it's actually the whole streams of revenue. They are bigger than what I originally thought, and it looks like crvDAO would earn I would say something comparable to what YB-DAO earns from YieldBasis. So this is what it seems to me.
Oh, okay. So that's
So it's actually fairly huge. It's just not direct revenues all the time. But when volatility of Bitcoin was particularly large, you probably could see that crvUSD was the stable coin with the biggest trading volume on Curve in total already, with just 150 million TVL on YieldBasis.
yeah. And so the way crvUSD works, it's similar to the MakerDAO model, or
in a sense, you can say that it's a CDP, so in that sense, it's similar to MakerDAO. It has few unique features like reversible liquidations. So if you if price goes down and your collateral gets converted to crvUSD, but if price goes up, your collateral gets converted back to your collateral, and you kind of didn't lose your collateral on the bottom, so you didn't sell the bottom. That's nice. That's one of the things why crvUSD is so cool. Another thing is stabilization mechanism of crvUSD is well, something we called peg keeper, which works, I think, better than anything else for keeping the peg tight.
Cool. So what's the timeline now in the upcoming milestones for YieldBases? So you mentioned the protocol upgrade.
Yeah, we use so
The volatility.
Pools,
What else is coming?
yeah, pools upgrade, I think it's gonna happen, well, either well, maybe on Monday is fine, because I will have all the feedback and we will implement all this in UI, but it's actually ready in code. So well, maybe possible to do it on weekends, but I don't know if people are up to that on weekends. So anyway, it's imminent for the upgrade here, but you need people to actively migrate liquidity, because in everything I build, I make non-upgradable contracts. So you cannot upgrade contracts which hold liquidity, and that's by design. But also, on Monday, I think, the vote on Curve will finish. The vote to spend YB allocation on incentivizing crvUSD pools. And these YB will be used for buying votes for crvUSD pools, and that's happening on Monday. That means that on Thursday, incentives for crvUSD stablecoin pools will go up, and the pools will start increasing their size. And it means that after that, TVL of YieldBases can be further increased, with the caps further increasing. So, well, how long after that will happen is a good question, but technically in a few days it's ready. So that's, I think, the next step. Also, we have this upgrade of the pools, and then increase of the cap, and then we really need to turn the fee switch on to connect the admin fees to VEYB, so that VEYB earn those sweet admin fees. And after that, the system will be like fully connected. After that, it should work for, I don't know, a couple of more weeks in this mode, connected. So, well, first of all, as I said, we would be ready to raise the caps after Curve stablecoin pools get incentives, and the raise should be then to maybe $500 million. And then we need to connect admin fees to the EYB. After that is done, I think in a couple of weeks, we would be ready to raise the caps a little bit more than $500 million. I don't know, 1 billion or 2 billion or something. We will see. After that, we probably should watch and continue raising the caps. You cannot really raise the caps instantly, because you don't want to affect crvUSD stability. You really grow two things together: YieldBases growing up and crvUSD growing up, because crvUSD is used as the stable coin in YieldBases. Of course, I could try to make a deal with some of the established stable coins, I don't know, Tether or something. But I created crvUSD. crvUSD is making revenues for CurveDAO, and I'm very incentivized to do it with crvUSD. So yeah.
Cool. Well, it's fantastic. I really enjoyed the conversation with you, and I think it's a super interesting, fascinating protocol. And I think this could absolutely become massive. So it's been really exciting to talk with you about it, and to sort of be a part a little bit of this evolution. And I'm really excited to see how YieldBases is going to develop in the next in the next months and the next years.
Absolutely, absolutely. It's a fascinating thing. I'm very excited to see that it actually works, and it actually works as predicted. So just the numbers they are pretty much matching the simulations. That's so exciting to see.
Yeah, absolutely. Cool. Thank you so much, Michael. It was a big pleasure having you in the show.
Yeah, thank you.